If you're selling on Amazon right now, there's a really good chance you have a tax problem building in the background and you don't even know it yet. And I'm not talking about some tiny thing. I'm talking about the kind of thing that comes out of nowhere and eats into your margins. And look, I know what you're thinking. Travis, please don't make a video about taxes. I get it, it's not the sexiest topic, but stay with me for a second because what I'm about to show you is not really about taxes. It's about a costly mistake most people don't find out about until it's already a real problem. So here's something that I think about a lot, especially as more and more of my students start scaling their businesses. When you first launch on Amazon, everything feels pretty clean. Amazon handles a lot of the complicated stuff for you. You're focused on your product, your listing, your PPC. That's where your brain is, and that's exactly what you should be doing when you start. But as you grow, you start to add things. Maybe you open a TikTok shop, which is a huge thing to do in 2026 and something I talk about a lot on this channel, or maybe you expand internationally. Every single one of those decisions is a smart business decision, but every single one of them also changes your tax situations in ways that most sellers are completely unaware of. When you sell on Amazon, Amazon actually collects and sends sales tax on your behalf in most states. It's called marketplace facilitator laws, and it feels great. Amazon has it covered. Box is checked, move on. But marketplace facilitator laws only apply to sales that happen inside that Amazon marketplace. That's it. They stop there. The second you open a Shopify store or launch on TikTok shop through your own setup or expand to Canada or Mexico, none of that is covered by Amazon. Those are completely separate channels, and the responsibility for collecting and remitting tax on those sales falls on you. Most sellers don't realize this until they're already well past the point where it matters. This is where economic nexus comes in. Economic nexus means that once your sales into a specific state cross a certain threshold, you are legally required to register in that state, collect sales tax from customers there, and send that money to the state government. In most states, the threshold is $100,000 in revenue or 200 transactions. Once you cross it, the obligation is triggered automatically, no notification, no warning, nothing breaks. And here's the problem. Your Amazon revenue, your Shopify revenue, they are all sitting in different places. None of those platforms are automatically adding it all up and telling you when you've crossed the threshold in a specific state. Let me make this real with an example. Let's say you're doing $45,000 a month on Amazon. Marketplace facilitator laws are handling your tax there so you feel covered. Then you launch a Shopify store, which is a smart move. You want to build your brand and own your customers. Your Shopify store starts growing, maybe $6,000, $8,000, $10,000 a month. And let's say over the course of a year, your Shopify revenue in Texas goes over that $100,000. That triggers economic nexus. You are now legally required to register in Texas, collect sales tax on those Shopify orders, and remit it to the state. But because Amazon was covering everything on the Amazon side, you assumed maybe that tax was already handled. You weren't watching your Shopify revenue by state. Nothing flagged it. And now you've been selling into Texas all year without collecting tax on those orders, and that is a real liability, and it belongs to you. Now take the same scenario, and on top, you land a wholesale account. One big purchase order can spike you over the threshold in that state immediately. The reason this keeps happening isn't because sellers are doing anything wrong, it's because the data is spread across too many places and nobody's watching the combined picture. Your Amazon numbers are in Seller Central, Shopify revenue is in Shopify, Stripe is somewhere else. Nobody is automatically pulling all of that together, state by state, and telling you where you stand. And most founders find out about this problem in one of three ways: during a financial review, during due diligence when they're trying to sell their business, or when they get an actual notice from a state. At that point, you might have to calculate back liabilities going months or years, back taxes, interest, penalties. All of it comes straight out of the profit you thought you had. This is exactly why I want to talk about Kintsugi, because this is a real problem and this is specifically what they built their product to solve. Kintsugi is an AI-powered platform that automates sales tax compliance for e-commerce businesses. About 80% of their customers are e-commerce brands, a lot of them on Shopify, a lot of them multi-channel sellers doing Amazon plus Shopify. This is exactly the situation I just described. Here's what it actually does. It connects directly to all your platforms: Shopify, Amazon, Stripe, TikTok Shop, WooCommerce, and more. It pulls in all your revenue across every channel and monitors your exposure in real time, state by state. You can see where you're approaching a threshold and where you have already crossed one. Instead of finding out months later, you see it as it happens. The AI side of the platform is handling the messy part of your data, organizing transactions across platforms, classifying products correctly, and cleaning up incomplete address data. The actual tax calculations are done with deterministic rules, not guesswork, and their tax experts are always in the loop. Human reviewers are involved in validating taxability decisions, so it's not just an algorithm running on its own. Once your exposure is confirmed and you need to act, Kintsugi handles everything, including registration in the states where you have obligation, calculating the correct tax on each transaction, filing in remittance. The whole thing is automated so it stays hands-off as your business grows. They also operate in 35 plus countries, the US, Canada, Australia, Mexico, most of the EU. So if international is part of your plan, the infrastructure is already there. The first thing you need to do is go create a free Kintsugi account and run an exposure check. You connect your platforms and it shows you exactly where you've already crossed thresholds and where you're getting close. You don't have to commit to anything. You just get to see where you actually stand. Even if you think you're fine, check. Because the whole point of everything I talked about today is that this builds quietly. You don't feel it happening. The only way to know is to actually look and think about what the alternative looks like. You'd either need to hire someone who understands multi-state tax compliance, which is not cheap, or you'd be paying your accountant extra every time something changes. Kintsugi basically replaces that entire cost with a platform that runs in the background automatically. Links in the description, go run the check. And one thing I've learned building multiple businesses and helping students build theirs is that the problems that hurt you most are rarely the obvious ones. They're the quiet ones that grow in the background while your focus is on the stuff that is exciting. Growing revenue is exciting, new channels are exciting, hitting a new sales milestone is exciting. But part of actually building something that lasts is making sure the growth is clean, that when you look at your profit number, that number is real. There's nothing hiding underneath it that's going to come out and cut into what you've built. Sales tax is one of those things. It's not hard to deal with when you're ahead of it, but if you wait until it's a problem, fixing it is a lot more painful than it ever had to be. Go run the check. The link is in the description, and make sure to hit the like button on this video.